Year to date, we're starting to see a lot of stocks rebound from red positions into the green, but this is just something we haven't noted from the Mag 7. In fact, every single one of them is down, other than Meta, which is currently up 7% year to date. And if you are someone in the camp of Bank of America who believes the S&P is going to be down 40% in 2025, then you could argue there may be some rationale in waiting for stocks to go lower before even considering buying, and that also encapsulates the Mag 7. And maybe some support for that argument could be that the forward valuations of many companies are still very high, not only on a historical basis, but also in comparison to their 5-year averages. And the only one that you could argue looks a little bit enticing purely based off the forward valuation is Alphabet, which sits below 20, the only one in fact sitting at 16.8. And to contrast that with Tesla stock, which is the highest currently trading at a valuation of 74. Now, as a side note, before we even get to the episode, I just want to shout out to every single one of you in the community. I started this channel 2 years ago today, and we have built something great, and I just want to say thank you to every single one of you. And getting back to the episode, Goldman Sachs believe the Magnificent 7 are going to be a little bit less magnificent in 2025, where we can see the performances have been very strong. 2023 notably up more than 60%, 2024 whilst a decrease to the previous year still up 20%, and the expectation is 2025 we're not perhaps going to see those double-digit returns we have gotten used to at least for the last 5 years. And the rationale behind their thesis is that these companies in the Mag 7, whilst they've been growing at some very large rates, they're going to need to continue to do that in order to justify their share price valuations and for them to continue to rise, something that they believe right now is going to start to come to a halt. And if we look back at the last 2 years, the Magnificent 7 accounted for more than half of the 57% rise in the S&P overall, and that gap is starting to reduce. In fact, 2023, they were up 76% in terms of the return of the other companies, 14%, and 2024 we noted a 22 percentage point, and they're now anticipating in 2025 not only is it going to start to come down, but quite significantly somewhere around the 7% point, and they do point this down to earnings growth. In fact, they're highlighting this as the most concentrated stock market over the last 100 years, and this is something we should at least take a note of. And we can also note in terms of the Magnificent 7 weightings, they do incorporate around 34% of the S&P, and for example, if you do hold an ETF like VO that does track the S&P, what you will in fact find is the Mag 7 does make up the top 10 holdings. In fact, every single one in the top 6, we do in fact notice Tesla at 1.62% is the 10th, so you get the idea. If you are investing in the S&P, you are pretty much betting that the Mag 7 are going to continue to perform at a very impressive rate. The question is, can they still sustain earnings growth in order to justify the share price? And we also get that visualized here. Over the last few years, we are noticing the earnings growth between the Magnificent 7 and the S&P 493, effectively removing those 7 companies, getting narrower and narrower. And as we've just highlighted, the stock market right now is very concentrated in those 7 companies. Now, we've already flagged year to date, only Meta is actually positive, but when we look at over the last 12 months, for the vast majority, they have returned some very strong numbers, with Tesla, the outperformer, up 63%, maybe something that does surprise you given the volatility we do notice from this company. And over both the last 5 and last 10 years, Nvidia has been the outperformer, up 23,685%. The key thing to realize here though is past performance is not an indicator of the future. Yes, they have performed very strongly. Whether or not they can continue that is definitely something to think about, because over the last few decades, when you do take a look at the top 10 S&P 500 companies, they have typically changed for the large part. Now, one person who is very bullish on the Mag 7 given the drop is Morgan Stanley CIO, their Chief Information Officer. He believes that the Mag 7 right now are winners. They are companies you should be investing in at the drop they have seen. But as always, we need to do our own due diligence. We also don't know the possible hidden agendas they may have, but it's interesting to note that a lot of people are now coming out being very bullish given the drop we have seen year to date. Although, as we said, you could argue that isn't even a large drop, because once every year we do see a moderate correction of 10% or more, around once every 2 years a severe correction of 15%, and once every 3 years a bear market of 20% or more. Lots of factors you need to consider and something we do want to draw to your attention. Now, Morningstar also have their own ideas of which companies in the Mag 7 right now are undervalued. We can see here their values above 1 indicate an overvaluation, with values below 1 indicating the complete opposite. And it's quite interesting to note, right now they're also very bullish, like Morgan Stanley CIO. They only have one company that they actually see as overvalued, and that is Apple stock, one we have talked about for quite some time, one that we do believe perhaps the growth drivers are starting to slow down, with every single one, as we can note here. That includes Tesla, Nvidia, Amazon, Microsoft and Google, all as undervalued, with, and probably no surprises, Alphabet being the one that does look severely undervalued. Now today we want to run through each one of these Mag 7 very briefly, give you our own analysis based on our own discounted cash flow model. We're also going to put timestamps just in case you only want to look at a few of the Mag 7, starting off with Nvidia, which is up 27% over the last year. Year to date, down double digit, negative 10%, and over the last 10 years, massive outperformance of the S&P, up 22,818%. Trading in the midpoint of the 52-week range, a little pullback from the all-time highs of $153, with a strong buy rating from Wall Street, a buy from Seeking Alpha, and a yield, although very trivial, payable of 0.03%, and a forward PE sitting around the 27 mark, which, as we can flag right now, is one of the lowest it's traded for over the last 5 years, and well below their 5-year rolling of 42.9. This is what we would call perhaps a severe undervaluation signal, and we'll also show you through this method, although bear in mind we're not looking at any of these models in isolation, we will run through our own DCF, that the company is trading severely overvalued, massive disparity between where the company sits and the blue tunnel, which indicates the expected intrinsic price. Again, severe undervaluation, and what's nice to see is that over time, or at least over the last year, their share price has been expected to increase, and therefore we would say this is a very good opportunity to at least consider in the overall portfolio. We also have to flag they are anticipating double-digit growth to their earnings per share over the next 4 quarters, whilst also outperforming over the last year. And just in their most recent earnings on a quarter-by-quarter basis, revenue up 12%. Their largest driver, as I'm sure you're aware, data center, making $36 billion from the quarter $39 billion, but we do notice a little bit of a drop on both the gross margin and the operating profit, and when we have done our deeper dives, their margins, even with this small drop, are absolutely phenomenal, not only an increase from their historical figures, but also significantly higher than the overall sector. As we said, we're going to run through each one in terms of our own intrinsic value. For Nvidia, $162 derived from the DCF model. We have the free cash flow year on year, average growth over the last 5 years, 153%, over the last 10 years, 104%. Moving forwards, we have gone for 20%, as you can see, low, medium and high. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Nvidia or any others. But based on 20% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get 162, which signals 34% upside. Now we'll also show you, for those that believe that is way too high, at 15%, $115, downside of 5, and for those that are a lot more optimistic, at 25%, 227, indicating 88% upside. Now, as we typically do on this channel, we take the median rate of 20%, where we're not just done, because we do apply a margin of safety, 10%, kick that off, execute on that if it meets the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that today, a buy at $146, then we keep going till it's near the current trading price, and what we're effectively saying, not a 30% MOS just yet, that's at 114, but in today's episode, you're getting bang on a 25% margin of safety. Wall Street, as we saw, strong buy rating earlier, they see this at $178 over the next year, translating to 47% upside. As always, as we go along, give us your thoughts about the Mag 7, whether for each one you see them as a buy, hold, or sell. Now, before we continue, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of March, lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 97 stocks that Wall Street believe have the most upside in the S&P right now, so click below, you can sign up and read straight away. We then move on to Alphabet. If you remember, it is the company in the Mag 7 trading at the lowest valuation on a forward P basis, up 13% over the last year, down 10% similar to Nvidia year to date. Over the last 10 years though, massive outperformance of the S&P, up 527%, trading in the mid to low end of the 52-week range, a double buy from Seeking Alpha in Wall Street, a yield payable of 0.48%, a forward P here sitting around the 18 region, which as we can see is significantly lower than their 5-year of 22.3, so another possible severe undervaluation signal. And then we move on to this model here, again we're seeing undervaluation, disparity between where it sits and even the lower end of the expected price. And they also expect growth to their earnings per share, 2 of the next 4 quarters being double digit with a 100% historical track record. We also like the fact their revenue is up double digit, 12% over the last quarter on the year-on-year comparative. We see efficiencies to their margin up 1 percentage point, and on their operating 5, and on their bottom line up 4, as well as growth to their search advertising at 13%, one which analysts are saying is starting to die, and their fastest growing revenue stream, Google Cloud, up 30%, and that is faster than the number 1 in the industry, which is AWS. We then jump into their valuation, intrinsic price $226, derived from the DCF model where we have the growth rate at 12%, low, medium and high 10, 12, 14% respectively. At the 12%, it does give us $226, and as we do run it through the margin of safety today, you will in fact note still a nice MOS even after the increase today. You're getting a 25% with Wall Street themselves seeing this at 220 over the next year, translating to 29% upside. Now we'll also show you, for those that are a little bit more conservative in terms of the estimate, at a 10% growth rate what the margin of safety would be, and we can see you're getting at least 10% up to 177, and in fact near the 15% mark with Wall Street's untouched at $220, 29% upside. We then move on to Meta Platforms, up 24% over the last year. As we said, year to date, the only Mag 7 which is up nearly 7%. Over the last 10 years, up 666%, and it's trading in the mid to upper end of the 52-week range. A strong buy from Wall Street and a buy from Seeking Alpha. A yield of 0.34% and trading at a valuation around 24 to 25, which when we look at it is pretty much around the forward P on average over the last 5 years. So you could argue pretty much reasonable valuation, something that again is confirmed when we're looking at this model. The trading price is sitting well within that blue tunnel. However, they only expect 3 of the next 4 quarters in terms of earnings to be growth with a 100% historical track record. Very nice beats quarter on quarter in 2024. And just in their most recent quarter, we can see revenue up a very large 21% with efficiencies noted to all 3 margins. Now the DCF model is giving intrinsic price just under $700, where we've gone for the lower end today at 10%. As you can see, that does give us $699. At the 12%, it would be $805, 29% upside, and 14%, $925, translating to $48. So we have been what we consider to be fairly conservative, and you are still getting a margin of safety pretty much bang on 10%, the smallest out of those we have covered so far, with Wall Street themselves 764 over the next year, 22% upside, but we'll also flag for those that want 15%, believe it is achievable, $595 price target, at 20% around 560, and at 25, 525, but as we said, right now for Meta Platforms, 10% MOS and 22% upside. We then move on to Tesla, which is up 64% over the last year, year to date down 30%. Over the last 10 years though, massive outperformance of the S&P, up more than 2,000%, trading in the mid to low end of the 52-week range. They have a triple hold right across the board, no dividend payable, and we can see a very high forward P sitting just above 100. Now we'll also flag that is well above the sector median at 15.2, so you are paying a 584% premium. But actually, when you compare it to what they've been valued at over the last 5 years at 117, it is now sitting 11% lower. Whether you believe that as an undervaluation signal or not, that is completely up to you. We also noticed their most recent quarter of earnings, they were up around 2% year on year, but their automotive sales were down double digit, negative 10%, with some deficiencies noted to their gross and operating profit, with a massive 22 percentage point drop to their bottom line net profit margin. They also anticipate 3 of the next 4 quarters to be growth to the EPS, and over the last 4 quarters, they've actually missed 3 of them, giving them only a 25% track record, and our intrinsic value comes to $203. You'll notice we've used 35% growth to the free cash flow moving forwards. That is a negative 28% downside to the share price. If you believe 30% to be appropriate, negative 47%. But if you're someone that believes they can grow their free cash flows over the long term at 40% year on year, then what you are saying right now, that has already pretty much been baked into the current value. But as we do like to use the median rate of 35% today, this effectively tells us that the company is trading at quite a significant premium, but some people believe that some companies deserve a premium. Wall Street, however, fairly bullish, even with their hold rating. They see this at $350 on average over the next year, translating to 25% upside. We then move on to Amazon, which is up 14% over the last year. Year to date, down nearly 7%. Over the last 10 years, pretty much up 1,000%. Trading in the mid to upper end of the 52-week range, a double strong buy from Wall Street and Quant, a buy from Seeking Alpha, and a forward valuation of 32 with no current dividend being paid to investors. And you can see they do trade at a premium in comparison to the sector, sitting now at 110%. But believe it or not, over the last 5 years, they've been trading at a value of 176, and right now that is 82% lower. They also grew their revenue around 10% year on year. Remember, we saw Google Cloud growing a lot faster than AWS, which sits at 19% year on year, but we do note efficiencies to every single margin, and we also notice green right across the board. Now, our intrinsic price of $230 is derived from a 20% growth rate moving forwards. Again, you could argue that is at the lower end. If you are someone who believes 25%, as we will show you, this indicates 59% upside, a $325 price target, and at 30% to the free cash flow, 454, indicating 121% more than a double from today's price. Now at 20%, when we do take it through the margin of safety, you are getting a 10% MOS pretty much around the current price. With Wall Street, we saw the strong buy rating, 270 over the next year, translating to 32% upside. Now for those that believe it should be a lot lower, at 15%, 196 is the acceptable buy price, at 20%, 184, and at 25, around 173. But right now, as we said, just 10%. And don't forget, you can always grab a copy of this model by clicking on the pinned comment below. We then move on to Microsoft, which is down 7% over the last year, and year to date down 6%, over the last 10 years up 880%, trading near its 52-week low. Another strong buy from Wall Street and a buy from Seeking Alpha, one of the high yields, if not the highest today, at 0.84%, and a forward P sitting around the 29.30 region, which is slightly lower than the 5-year average of 31.7, so you could argue potentially some undervaluation signals. And then when we take a look at this model, we can see it right towards the bottom, if not slightly in at the lower end, so again, possible undervaluation. And if we look at their latest quarter, revenue up double-digit 12%, with efficiencies noted to their gross operating and a small drop to their bottom line net profit margin. We also see green right across the board. As always, we love to note that EPS growth expected for the next year and a 100% historical track record. With our intrinsic value at $488, we have used a 16% growth rate moving forwards. That indicates 24% upside, 7% if you use 14%, and 42% if you do use 18%. In terms of a margin of safety, you are getting one today. It will be higher than what we did just in fact note for Amazon. At 10%, a buy at 439, at 20% around 390, so you could argue a near 20% MOS, with Wall Street themselves and their strong buy rating seeing this at $508 over the next year, translating to 29% upside. We then end on Apple, which is up 31% over the last year, year to date down 11%, over the last 10 years up 612%, again all of these 7 massively outperforming the S&P during the same period, trading in the mid to upper end of the 52-week range. Just one buy rating, that is from Wall Street, with a yield at 0.45% and a forward P now sitting in the 30 region, which as we can see is above the 5-year average, indicating possible overvaluation. And this is the same signal that we do note when we look at this model. It is trading towards the upper end, so you could argue reasonable valuation or perhaps slight overvaluation. We also noticed their revenue was up around 4% year on year. That is pretty much just in line with inflation, with iPhone sales their largest income stream at $69 billion, down 1%, and some small efficiencies noted at 1 percentage point to every single one of their margin. In terms of their earnings, green across the board, as always, something we love to see. Then we jump into the valuation where we get to $200. We have used 8%, which we do believe to be appropriate, but we can show you here 8, 10, and 12, 8 giving us a value of $200, downside of 10%, 10% giving a value of 231, upside of only 4, and a high rate of 12%, 266, indicating 19% upside. So what this signals to us, in our opinion, Apple right now is trading at a premium. Again, some people will believe that a company like Apple deserves it. If you wanted a 10% MOS, a buy at 180, at 20% around 160, and at 25 around $150. Wall Street themselves, we do notice a buy rating, but they only see $250 over the next year, and this translates to 12% upside. As always, give us your thoughts about the Mag 7. Is each one of them a buy, hold, or sell? Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.